Perfect. So today we are going to discuss about section D, which is risk management. So today, before starting the session, I wanted to know from you all, what is meant by risk in your perspective? If you had to define risk, what will be your definition? Okay. Yes. So we will start the discussion now. So what is risk? Risk is a probability that negative events might ruin our objectives, ruin us from achieving our objectives. That is the risk factor in an organization. Now, when it comes to risk, starting from the business inception till we end the business, throughout all the activities we do, risk is involved. Okay. So from the starting of the business till we end it, risk is one of the important factors that impacts our business. So there is an essential need that we have to manage this risk well so that we are able to achieve our objectives. Okay. So now risk management is one of the crucial actions that any business has to take. So now they start by defining what are the types of risks that is impacting the business and how they can face the risk in the organization. What will be their response towards various risks that is impacting their business? So event or action that keeps an organization from achieving its objectives. Yes. Risk is any event or action that may prevent an organization from achieving its objectives. Perfect. Good. Okay. Guys, can you confirm if you're able to see my screen? Just a minute. Okay. So the main topics that we need to understand in the risk management is what are the risk fundamentals and what are its types. Then comes our risk management process. What are the 5 steps that we need to take in order to effectively manage a risk in the organization. Then comes risk assessment and quantitative tools that are available for assessing the risk. Then risk response strategies. How do we respond to the various risks that we have notified in the business? Then ERM, that is enterprise risk management. This system, this framework was a very systematic approach given to the business to manage their risks effectively. Then comes capital adequacy ratios. So we start with risk fundamentals and types. So risk is any action that prevents an organization from achieving its objectives. Then, how do we manage this risk? Okay, so risk management is an effective process. So here we will take various steps in measuring, analyzing, and responding to the risks that we are facing in a firm. Then comes our systematic approach, which is known as enterprise risk management. So what is this enterprise risk management in the sense? Each of the organizations had their own approaches for viewing the risk and responding to their own risks. But enterprise risk management gave them a systematic approach, saying that risks should not be identified individually. Risks are not independent from each other, they are interdependent. That means they have their interrelations. One risk can pose up to two or more other risks. They are all interrelated. So they brought in entirely a different approach into risk management. So here they follow top-down approach. Top-down approach in the sense, the highest prioritized risks, that is strategic risks, that will be solved first. Then we will move on to the lowest risks of the organization. That is top-down approach. Then how do we manage the risk? That is not in the individual department's perspective alone. All the risks are interdependent on each other. So here we will be combining the individual department perspective and the organization's perspective in evaluating risks. So that is called as building a portfolio of risks. So now we will move into the types of risks. So before we discuss, can you guys tell me what are the types of risks? What are the four main types of risks? What are the four main types of risks in a business? So that is risk responses. Yes, that is risk response. So there are types of risks. I'll give you one type of risk, hazard risk. What are the other three types? Strategic risk, perfect. Business risk, strategic risk, operational, financial, and hazard. Perfect. Okay. So first up, hazard risk. So what is this hazard risk? So in an organization, there are some risks for which you can buy some insurance coverage. Okay. So for example, if there are any losses that are caused by natural disasters, and if there is any death of a key person in a company and some other risks like fire accidents and so on, for that you can insure yourself. So that type of risk is a hazard risk. So how do you define it? These are the risks that are coverable by insurance. Then comes strategic risk. Okay, so strategic risk, as the name itself says, this is the highest level of risk that affects the entire organization. Okay, so as I told you before, from the start of the company, when we start the business till its end, risk is involved everywhere. So when we plan our strategies, even in our strategies, risks are involved. Okay, so when we plan our strategies, we will be viewing into various internal and external factors. Okay, so let us assume that I am planning a business strategy to open my own MNC in a foreign country. Okay, this involves various risks. First risk will be political risk. Will my MNC find its place in a foreign country? Will the political parties even allow me? Will the government allow me? So what are my challenges? What is the inflation rate? Are we in any war-prone area? Or what are the other economic factors such as interest rates, inflation, forex? Everything is involved in a strategic risk. Okay, so these are entity level risks. It affects the entire organization. Okay, and the main forms of strategic risk, the first important strategic risk that we will be facing is political risk. Then comes reputational risk, risks due to competition and economic factors. All of them come under strategic risk. Then comes our operational risk. So operations, as the name itself says, these are the risks that we face in our day-to-day operations. Okay, so we define operational risks saying that these are the failures in people, processes, or systems. Okay, so now operational risk. When we speak about the day-to-day activities, it starts all together from our suppliers. Okay, from the way where we get our raw materials, how we process it, how it reaches the customer, all of it is our day-to-day activities. Okay, so all together I can say that entire supply chain, starting from raw materials procurement till we deliver the final goods to the customer, everybody will be impacted from operational risk. Okay, so then two major subtypes of operational risk will be your legal risk and compliance risk. Okay, so there is one common confusion among students whenever they are asked questions about types of risks. Okay, so there are only four types of risks. The main segregation will be between hazard, strategic, operational, and financial. Suppose they are asking you a question where they stress about the political imperatives in a country. Okay, so your mind focuses on the keyword political, and they are asking you what is the type of risk involved. Okay, and in the options they give you political risk, strategic risk, hazard risk, and financial risk. What option do you choose? I repeat the options again. First one will be your political risk. Second is your strategic risk. Third is your hazard. Fourth is your financial. Which one do you choose? Should I repeat the question again? Strategic. Okay. What about remaining students? There is a scenario where they speak about the political imperatives in a country. Okay. And they ask you what type of risk is this? And they give you four options. Option A, political. Option B, strategic. Option C, hazard. And option D, financial. Which one do you choose? So I've got two answers, strategic and political. So let me explain this to you. Political risk is not a type of risk, okay? It is subtype of strategic risk. When they give you two options, so first go for political itself. But in the MCQs, when they give you strategic risk and political risk, both of them as the options, you should choose strategic risk because that is the type of risk. And political risk is a subtype of strategic risk. Okay, so these are simple ways where many of them lose marks. So be cautious about what the question is asking. Okay, so next up we have financial risk. So financial risk means it speaks about the difficulties a company faces in raising its capital, in maintaining its liquidity, in its ability to repay its loans, both short term and long term, and also in its ability of paying regular interest payments and dividend payments to its capital providers. Okay, now when it comes to financial risk, not every company can raise capital with ease like many big four companies does and many MNCs do. It's not easy for every company to raise capital as easy as how Infosys does, as TCS does. It's not easy. So first risk they will be facing is raising sufficient capital. So then comes liquidity, maintaining ready cash so that they will have their working capital running on in the business. Then comes market volatility, their credit risk and debt. These are some of the financial risks a company faces. So now we will move on with business risk. So what is business risk? Can anybody define business risk? What is meant by a business risk? Okay, so in simple words, we call business risk as a risk that reduces a company's profit or which forces the company into losses. Okay, such type of a risk which businesses face is known as business risk. It will either reduce its profits or it will force the company into losses. So such kinds of risk is known as business risk. Now, what are the risks that can be called as a business risk? First is demand risk. Okay, so customers and their preferences change. It is constantly changing. So it depends on the type of business which is focusing on the customer. If customers are not demanding the products of the company, then obviously its profit will reduce. Then comes pricing risk. Okay, so we have learned the concept of cost leadership. So when there are more competitors in a business, then businesses will be forced to reduce their selling prices for the products. Okay, so that will be pricing risk. They will not have this autonomy of keeping their own selling prices for the product. They will have to keep it as low as possible in order to survive in the competitive markets. That again is a business risk. Then comes input cost risk. Okay, input cost risk is involved with the raw material costs. Suddenly, if the price of raw materials rises, then it is subject to input cost risk. Cost is increasing, but we will not be able to increase our selling prices. Obviously, profits will come down. Then comes operating leverage. If we have high fixed cost that is scaling the small sales changes, that is bringing the small sales changes, obviously profit will slow down if you're focusing on higher fixed costs. So these are some of the business risks that might emerge. Okay, so now let us understand strategic risk and operational risk in detail. Okay, so as I told earlier, strategic risk is an entity level risk. So it is involved in the strategy, it's involved in the very strategy that the business is planning. So it will involve all the external forces such as economy, politics, global markets, repatriation, and everything. So there is one more strategic risk that we usually focus on. Okay, so which is known as expropriation. Have you guys heard of expropriation? What is meant by expropriation? Hello guys, respond. The more interactive you are, the better the revision will be. What is expropriation? Okay, so expropriation is nothing but the forceful seizure of property by the government. Okay, so governments out of their own regulations, so government has the highest authority in any given country. Their decision will be final. Okay, so they can acquire the private property of the company by giving them either minimal compensation, not even the worth of the asset they are seizing. Okay, or they might not give any compensation at all to the company. So this forceful taking of the asset from the company is known as expropriation. Okay, and that is the biggest political risk that we can face under the strategic risks. Okay, then other political risks involved will be unstable governments, so which we see regularly in India. So whenever we see different political parties in state and in the nation, so obviously many businesses will face consequences of that. Suppose we have the same political party that has won in the state and in the nations. At that time, businesses run well, comparatively well. So unstable governments is also biggest strategic risk. Then comes corruption, and sudden taxes, they will suddenly increase the taxes. So recently we saw that due to the trade contracts between India and US, so there were some clashes between the two countries. Then suddenly import taxes in US were raised to 50%. So that is a strategic risk. Then currency devaluation, which we are facing now. So right now, what is Indian rupees converted into US dollars? To purchase one US dollars, today we will have to pay somewhere around 96 rupees. So that is currency devaluation. So then comes expropriation. As we discussed, it is forceful seizure of company's property. Okay. So then moving on to the operational risk. So these are the risks involved in failures in people, processes, or systems, or it can also be caused from unexpected events. So what are the main forms of operational risks? So first up, we have process risk. Mistakes in task execution. So the more the mistakes that happens in a firm, the lesser our efficiency will be. Okay. So we have heard of this. The more the errors that we do in a company, the more will be the cost that we are incurring to correct those errors. And if cost increases, obviously our efficiency comes down. So that is process risk. The more the mistakes, the lesser the efficiency. Okay. So then comes people risk. So there are many errors and fraud that people commit in a firm. So those risks, those errors again cause operational risk. Then comes technological risk. So right now, technological risks are higher in frequency when compared to other risks. So these involve cyber attacks, IT failures, system glitches, and many more. Then comes supply chain risk. As I told you, operational in the sense day-to-day activities. So our day-to-day activities start from the time when we purchase the raw materials till we deliver goods to customer. That means supply chain risk is present. Then comes business continuity risk. Okay. So when natural disasters occur, that affects the businesses which are prone to natural disasters, which are destroyed by the natural disasters. So business continuity risk in the sense, businesses don't stop there. When they are dissolved due to natural disasters, again they have to rebuild it. So that is business continuity risk. Then comes legal risks and compliance risks. These two are main forms of operational risks. Okay. Yes. So legal risks involve lawsuits, contract disputes, product liability. So legal risks means the risk that we are facing due to the laws and regulations that we have to face, that we have to follow. Then compliance risk. Compliance risk means every company which is present in a country, they will have to follow whatever rules and regulations country is imposing for the businesses. Okay. So if they fail to abide by the laws and regulations, that becomes the compliance risk. So if they do not follow the laws and regulations, they will be subject to punishments, fines, and taxes. Okay. Then, so now when it comes to strategic risk and operational risk can be controlled. Up to 90% we can control our operational risk, because when you look at it, most of the internal factors only are involved in operational risk. But when it comes to strategic risk, most of the external factors are involved. And whenever you see internal factors being involved, that means it will be in the organization's control. They will have maximum control over operational risk. If they make their minds, they will be able to reduce operational risk. But when it comes to strategic risk, it is external. We will not have any stake on external risk. So what can we do? So we will have to check which is the best approach for us given this external risk. How can we turn it into our benefits? So that should be the company's approach in strategic risk. So next up, we have financial risk and hazard risk. So financial risk, the biggest risk is capital availability. If capital itself is not available, how can we run the business? So now it's a difficulty in raising equity or debt. Then comes market volatility. So market volatility, interest rates, foreign exchange rates, commodity prices. So this market volatility it doesn't affect our domestic businesses much. Whenever a business has international exposure, whenever it is present in global markets, at that time market volatility impacts more. Then comes credit risk. So customers, most of the customers might default and they would not pay back to the company. That is credit risk. Then comes liquidity risk. So if a company is not able to meet its short-term obligations, that is its liquidity risk. So next up, we have systematic and unsystematic risk. So we have studied about this. Systematic risk in the sense, it's a market-wide risk. That means systematic risk in the sense, every company across every industry is facing this risk. It is common for everyone. Okay. And the reason that it is common for everybody, we can't diversify. What is meant by diversification? So if sector X is facing any risk, and there is another sector called Y. So if Y doesn't have this risk, I will focus on sector Y investments. I will withdraw some of my investments from sector X and I will invest in sector Y. This is called diversification. Okay. Now, when all the sectors are facing the same risk, we can't diversify it. So such type of risk, which is common for everyone, that is systematic risk. Then comes unsystematic risk. So this is industry specific. As it is unsystematic risk, it will be specific for industries. If one industry is facing this risk, the other might not. Now, diversification is possible. Okay. So then, compliance risk. So do not confuse with the compliance risk that is said here in the financial risk with the compliance risk in this slide. This is completely with response to the business operations. Okay. So in let us say, for example, in India, child labor is abandoned. Nobody is supposed to follow child labor. Okay. If a company is having many child laborers working for them, that is a compliance risk. They are not following laws and regulations. But what is compliance risk in financial risk? This is with respect to accounting, reporting, and tax penalties. That means we have to follow Indian GAAP. Here in this perspective, we have to follow US GAAP. Okay. Then debt risk. Insolvency if can't meet interest. Earnings volatility due to fixed interest. Debt risk in the sense, company, obviously, they will have their investors who have invested in their debt instruments, bonds, and so on. So now when they are not able to pay the interest back to them, that becomes their debt interest. And we know that bonds, they are regulated very well. If once they are committed with the bond holders that they will be paying the interest to them, they will have to pay it, or else they will be defaulting on that. Okay. And they will have the necessity to repay the entire principal amount with all the outstanding interest. Immediately, they will have to pay to the bondholders. That again leads to their insolvency. Okay. So next up, we have hazard risks. So these are insurable risks. If you have any trouble from the natural disasters, you can have property insurances. And again, this depends on the terms and conditions of insurance. So these are the general examples that we can look into. Okay. Then comes key employee death or illness. So key person life insurance we can purchase. Then comes injury on premises. This there is something called as liability insurance, especially for premises, business premises. Okay. Then comes vehicle accidents and damages. Collision insurances can be purchased. Then injury or damage to others, again liability insurance. Then comes director or officer errors. Okay. So we call it as E&O insurance. It is nothing but errors and omissions insurance. Okay. Then comes product harm, which is again product liability insurance can be purchased. So one thing you need to focus on here is any given risk, you will be easily able to insure it. Such type of risk, you call it as hazard risk. Okay. Then comes key features of risk, which is volatility and time. Okay. Let us understand this with a small example. When it comes to volatility, the best example I can take will be stock markets. Okay. So when compared to the individual shares of a company, if you compare individual shares of a company to gold ETFs. Okay. So everybody knows that gold is more stable than company shares. Company shares will be changing now and then. If you look at the stock market indexes, you will see various fluctuations in a stock's price in single hour. In 1 hour, you can see many fluctuations in the stock prices. That is not the case with gold. Okay, gold prices will also change, but not as frequently as stock prices. Okay, now we came to know that stock prices are more volatile than gold prices. Okay, now what happens? There are many investors who are afraid of taking risk in the stock markets. So they will invest everything in gold ETFs, silvers, and other such valuable bonds and ETFs, okay, which are not prone to fluctuations. Now, when it comes to stock prices, not many investors will invest. Only those who are able to face the risks, they will invest. Okay, so that is volatility concept. Now, why people scare to invest in stocks whose prices are fluctuating a lot? Because of risk. Okay, so volatility means changes. So if there are high number of changes constantly, then risk factor is more. Okay, then comes time. Okay, I'll give you one more example for this. Okay, so now assume two customers, customer A and customer B. Customer A is holding accounts receivable balance in your company from past 10 years. Okay, and there is customer B who is holding accounts receivable balance from past 3 months. Customer A has AR balance for past 10 years and B has your AR balance for past 3 years. So who is more risky for you? Customer A or customer B? Customer A is highly risky. Why? Because he is holding accounts receivable back from 10 years and we are not sure whether he'll pay us back or not. Okay, so that is why. As in how time increases, the risk factor also increases. And as in how volatility increases, risk factor increases again. Okay, so all of you are clear till here? All the 10 students, all of you are clear with risk and its types? Okay, so next up we can move on with risk management process. So risk management process again has 5 steps. So can anybody tell me what are the 5 steps involved in risk management process? Risk identification, assessment, yes. Then what are the other 3? Planning. Are you sure, Shreya? Priority, correct. Risk identification, assessment, prioritization, response planning, and monitoring. Perfect. Okay. So now we'll look into each and every step in detail. Yes. So we'll start with risk identification. In this step, any given risk, irrespective of whether it is important or not to the company, we will identify every risk from A to Z. Then the second step is risk assessment. So here we assess. So what is the risk factor involved in each type of the challenges that we are facing, each type of risk that we noted down? What is the impact of it on our business? That is risk assessment. Then comes risk prioritization. Once you assess the risk, you will come to know which risk is more impactful, which will cause highest risk for the company and which causes the lowest risk. You will come to know. And we will be prioritizing the highest risk factors first. Then comes response planning. So now anyhow we have prioritized the risk. We should know how we can respond to these risks. Okay, so we will have to find out the best responses for them. That is response planning. Then comes risk monitoring. Now you have found out the risk and you have also found out the way you have to respond to them. So the last step is you have to check whether your risk response is able to reduce the risk in your business or not. There has to be some change, some reduction in the risk in your company. Is your risk response able to bring that reduction or not? You will be monitoring in the fifth step. Okay, so first step is risk identification. Okay, so here, usually risk identification, it's a top level management and the board responsibility. Okay, so now they will analyze risk identification. As I told you, you will be analyzing both internal environment and external environment. We need to jot down all the risks that is being faced by the organization. Okay, so now in every individual department, from individual department till entire organization, every department and the organization as the whole, they will list down all the risks. So now to identify the risk, we should know what are the ways are present to identify the risks. So first up, we have brainstorming. So brainstorming is very simple. Here, there will be a chief officer. So, some of the organizations have chief risk officer itself, and some of them will be having some C-suite officers. Okay, so they will take this responsibility of finding out risks in a firm. So in this brainstorming, what happens is this chief risk officer or whosoever it may concern, the C-suite officers, they will hold a session, okay, with all the employees, all the managers, and everybody involved in a organization. And they will collect what is the risk factor they are finding in a business. So now you have to note down that from lower level till top level, everybody is involved in this brainstorm session. Depends on the company. Some companies only conduct a meeting with top level managers or the department heads, and some firms will conduct it from lower level management till top level. So here you need to focus that in every level of management, what is the risk we are facing, we will be able to identify. Then comes event inventories. Okay, so event inventories or loss of event data. Okay, so now what happens in this step is event inventories, in the sense we will be identifying the risk that is commonly faced by companies in a industry, in entire industry. Suppose we'll take an example. Right now, or in the recent past, there was a war that took place in the Middle East. Okay, so we know what are the consequences many countries had to face from this war, Middle East war. Okay, so the major industries that suffered were food and beverages industries and transportation industries. Okay, so now what happened? All the companies who are involved in food and beverages industries, all the restaurants, hotels, due to LPG inavailability, all of them faced an issue. Still, they are facing an issue. And in transportation, the auto rickshaw holders, all of them, and whichever vehicle is running on CNG, all of them faced an issue. Okay, so now that is what we jot down in event inventories. The common risks that everybody, every company in an industry is facing, that will be listed down. Okay, so then comes loss of event data. So now what happens is there will be the examples in an organization, okay, where they will have already faced some risks in their past and they will have responded to those risks in the past. They already have these records, okay, of past risk events and how much loss that risk had caused to the business and how they were able to come out of that risk. This data will be there. Okay, instead of preparing the risk response from the scratch, they will just take the insights from this prior experiences they have. Okay, and they will be planning the strategies out of that. That is in event inventories. Then comes interviews. Okay, so in interviews and self-assessment, what happens is each and every department, they know their department best. So they will be asked to assess themselves in terms of risk. Then every department will prepare their self-assessment for risks. Okay, and they will have to attend an interview with they will have to attend an interview with any of the C-suite officers, and some organizations have chief risk officer itself. From them, with them, there will be an interview where they will discuss what are all the risks involved in the departments and what is the best strategy for us to respond to this risk. That is in interviews. Then comes facilitated workshops. Again, this is similar. So here in the interviews, they will self-assess themselves. And in the facilitated workshops as well, here also, from employees till the top level managers, everybody can be a part of this. And some of the companies also involve the external stakeholders. Who are external stakeholders? They will be suppliers, customers, and also the shareholders. Okay, so now all of them will be involved. So here in facilitated workshops, what happens is the audience that you are covering for knowing the company's risk is very wide. You are involving both internal and external parties, external stakeholders. Here, the risk exposure of the company, you will come to know maximum all of the risk exposures of the company. Okay. Then comes SWOT analysis. As we all know, strength, weakness, opportunities, and threats. So here, there are two internal factors and two external factors. Okay. So can anybody tell me what are the internal factors in SWOT and which two are the external ones? Among strength, weakness, opportunity, and threat, which two are internal and which of them are external? It's very simple. Strength, weakness, international to external. Sandhya, can you retype it? I didn't get it. Internal is strength and weakness, good. Opportunity and threat is external. Perfect. Good. Okay, so SWOT analysis, all of us know. When you analyze strengths and weakness, you will come to know what are the risks that are present in the company internally. And as I told you, if it is an internal risk, you will have complete hold on it. 99% you can control it. Okay, then comes opportunities and threats, which are external to us. So if it is external, we will not have complete hold on that. But what can we do? We can search for strategies to turn these opportunities and threats to our benefit. Okay, so that is SWOT analysis. Then comes risk questionnaires and surveys. So what happens in risk questionnaires and surveys? Here, you will be preparing various questions that a company has with respect to its risk exposure. Okay, then this questionnaire will be circulated to internal parties and external parties, external stakeholders and internal stakeholders. And you will collect a survey from them. So what is the risk of the company? Then comes scenario analysis. So scenario analysis, there is another name for it. What if analysis. Okay, so now we are in a war-prone time. Now, I'll tell you one sample scenario analysis of a business. So now we are speaking about a company in food and beverages industry. So their scenario analysis can include, what if this war continues for another year? What will be our risk factors? Suppose this war ends in this month itself. What will be our risks? So this is how they analyze. They will analyze what could be future possibilities of events. Based on that, they will prepare a ready risk response strategy. Then comes your technology tools. So technology tools majorly we use in company. So we call it as intranet. Okay, what is this intranet in the sense? Within an organization, there is a need for communicating information about risk, especially as soon as possible. Okay, risk is a factor that you need to resolve it as soon as possible. For that, information should be communicated easily and very quickly. For that, we can use intranets in the organization so that communication of risk factors will be very quick in the firm. So this is how we identify all the risks that are impacting the firm. Our next step will be risk assessment. Okay, so risk assessment in the sense you will analyze. So what are the impacts that this particular risk can cause to our company? That is risk assessment. So here what happens? Analyzes the identified risks from three perspectives. So what are these three perspectives? First one is likelihood of occurring. How frequently are we facing this risk? Okay. In an year, approximately how many days are we facing this risk in our business? That is likelihood of occurring. Okay. Then comes potential impact. Suppose this risk is occurring in our business. How much loss do I have to suffer? That is potential impact. So then interrelationship between risks. So as I told you, there are some risks in a company. They are interrelated. One risk will cause two or more other risks for the firm. Okay, such interrelated risks should be resolved first, because if you find the solution for that first primary risk, you will be able to solve the other two risks. Okay, so these are the steps that we take in risk assessment. So now again, we have two major types of risks that we note down in risk assessment. First one is inherent risk, and next up we have residual risk. So let us understand this with an example. Okay, so now let us take an example of firecrackers firm. Okay, so now in this firecrackers firm, what will be the inherent risk for them? Event inventories. Sure, Rafia. So after completing risk assessment, I'll be getting back to that. Okay, guys. So I asked you all a question. Yeah. In a firecrackers company, what could be their inherent risk? It's very simple to find out. It's a firecrackers industry. I'm stressing it out. It's a firecrackers industry. What could be their inherent risk? Perfect. Fire accidents. Okay. So that is inherent risk. Due to the very nature of that business, this risk is present. That's a fire insurance company. Obviously, firecrackers industry. So obviously, they will be facing this fire accidents issue. That is their inherent risk. Okay. Now, what does this company do? They'll go and buy a fire insurance. Okay. Now, let us assume they are buying a fire insurance for somewhere around 1 crore rupees. Okay. Now, suppose a fire accident has taken place in the firecrackers company. Okay. And they have suffered losses up to 1.5 crores. And now, insurance that they purchase, the fire insurance, that is only for 1 crore rupees. So now, they will claim their insurance only up to 1 crore. Remaining 0.5 crores, that is their residual risk. That is the risk that is left even after mitigation. Even after taking measures, there is some risk that we have to face. That will be our residual risk. Okay. So now, the two major things that we focus on in risk assessment is loss frequency and loss severity. So what does this mean? Loss frequency in the sense, more frequently if a risk occurs in a company, that means there is a high probability of its occurring. Okay. And such risks, as it is recurring in nature, we need to address them first. Then comes loss severity. So what is this loss severity? If a risk comes, what is the loss that I am supposed to suffer? If it is somewhere around $50, we'll not worry about it so much. Severity is less. Suppose it is $500,000, severity is more. I have to face more loss. So such risks will be addressed first. Okay. So next up we have the risk map. So what is this risk map? So risk map means, so now we know that we have to segregate the risks based on loss frequency and loss severity. Based on that, we will be preparing a graphical representation holding frequency and severity on X and Y axis, and we will be plotting the graph with respect to what is the risk, what is its impact, or what is its severity and frequency. So the risks that have the highest frequency and highest severity will be addressed first. That is how risk maps work. Okay, and it is also known as risk heat map. Okay, guys, 1 minute. Okay, guys. So now, getting back to event inventories. Okay, in simple words, what you need to understand about event inventories is organizations will have a past experience of facing risks and losses. Okay, so in this past event, when they have suffered a severe loss or a financial crisis, they will have jotted down what were the steps they took in order to come out of the risk. Okay, that event inventories will be available for us. Now, suppose we've heard of this concept, history repeats. Like that, in some scenarios, same sort of financial risks can appear in the business. Okay, at that time, you can go through what were the responses we took in our history for facing the same sort of risk, and from that we can take insights and build our response strategies. Got it, Rafia? Yeah, okay. So next up we have risk analytics and quantitative risk assessment tools. So here, this one, risk map that we came across, it's a qualitative tool. In the risk assessment itself, there are two tools that we use, qualitative and quantitative. In qualitative, mostly used tool will be risk map. We also call it as risk heat map. Okay. Next, we have quantitative risk assessment tools. So, yeah. In this risk analytics, what is meant by risk analytics? Use of software to quantify risk exposure, run simulation or scenario analysis, and document actual and avoided events. Okay, so here you will be using technology, okay, or a software, and this software will help you run some quantitative statistical analysis. Okay, so we call it as simulation and scenario analysis. So scenario analysis, we know this. What if analysis? We will assume scenarios to that can take place in the future, and we will plan our responses accordingly. That is scenario analysis. Then we have simulation. Simulation in the sense, this is a very brief analysis. So here what happens is each and every economic factor will be taken into consideration. We know that if there is one scenario that needs to take place, there are hundreds of external events that will impact that situation. Okay. In simulation analysis, what happens is all the external factors that are impacting a particular business scenario that will be taken into consideration, and we will be evaluating for n number of times what could be the expected loss. Okay. So this simulation analysis, it's very tough for conducting it manually. We definitely need a help of software. Okay. So simulation and scenario analysis will help us find out what could be the possible losses. And this use of software to identify risks, we call it as risk analytics, a concept that is similar to business analytics. Okay. Now, what are the quantitative factors that we are going to address? So first up, we have value at risk. Okay. So what is this value at risk? Maximum potential loss of a portfolio over a specified time horizon at a given confidence interval. So what does this mean? Okay. So value at risk in the sense, what is the maximum monetary impact that could take place? Okay. Now, maximum potential loss of a portfolio in the sense, what is the maximum loss that we are focusing on to incur in a business. Okay, so now we calculate it based on a confidence interval. So what is this confidence interval? So this is speaking about the probability of an event to take place. I'll give you one example so that you can understand the confidence interval usage in value at risk. So let us take an example of this thing. Let us assume that a company is planning to get a sales of somewhere around 5 lakhs per month in the coming year. Okay. So now they have calculated a confidence interval of 95%. Got it? So now for this 5 lakhs of sales that we are expecting at a 95% confidence interval, what it means is if you are selling your goods for 100 days, 95 days, you will be getting 5 lakh rupees as your sales revenue. Now, what about the remaining 5 days? So, in remaining 5 days, for 2 days, your sales revenue can be less than 1 lakh. And for remaining 3 days, your sales revenue can be more than 5 lakh. You can calculate the fraction out of this. 2.5 percentage, we will divide it. Okay. So 95 days out of 100 days, you will get a sales revenue of 5 lakhs. Remaining 2 or 3 days, it can be less than 5 lakhs. Remaining 2 or 3 days, it can be greater than 5 lakhs. So that is the meaning of confidence interval. Now let us apply the same thing for our risk factors. Okay. Suppose a firm, due to various economic factors, if it is assuming that it can get a loss of somewhere around 5 lakhs rupees and it has found out a confidence interval of 90%. Okay. So now what happens? 90% of the loss that it is expecting, 90 days out of 100 days, its loss will be 5 lakhs. And remaining 10 days, it can be, you will divide it exactly into half the probability. 5 days, it can be less than 90,000. Okay, sorry. 5 days, it can be less than 5 lakh. And remaining 5 days, it can be more than 5 lakh. This is the concept of value at risk. Okay. So next up, we have cash flows at risks. So what happens with this cash flow at risk in the sense? It's a similar concept to value at risk. Okay. So now, what is meant by a cash flow at risk? I'll give you an example. Can anybody explain how it impacts us? Okay. So I'll tell you that cash flow at risk is at a confidence interval of 85%. Okay. So can anybody tell me how will it impact? Only one qualitative factor. Okay. I'll tell you the rest of the qualitative factors after we complete this. Okay. So cash flows at risk at 85% of confidence interval. Can anybody unmute and tell me how you will calculate this? It's very simple. Sumant, can you give it a try? Okay, I'll repeat it again. So there is a cash flow at risk at 85% of confidence interval. Okay. What does it mean to have a cash flow at risk at 85% confidence interval? Okay. So guys, it's a very simple concept. Learn to decode it. Okay. Suppose 85% of confidence interval in the sense cash flow at risk in the sense here we are speaking only about the cash flows. Okay, cash flows means we know the cash inflows that we are expecting in a firm. Now what happens? Cash flows at risk. How do you calculate this? 85% of the time you will be facing a cash flow at risk that you have estimated. Okay, and what can be your estimation of cash flows? It can be somewhere around, it can be any amount, 1 lakh or 1,50,000 according to your assessments. Okay, and what about remaining 15%? 15% you will divide it into two halves. So it becomes 7.5% each. So 7.5%, it will be below your estimate. Your risk will be below your estimate. Okay. And for rest of the 7.5%, it will be above your estimate. Got it? Okay. So next up, we have earnings at risk. Same concept. Here, measures the confidence interval for a decline in earnings. Here, only word that is changing is value. Value means not only cash flows, your entire business value you are seeing here. Next is your cash flows. Okay. So your cash flows, you will focus only on cash inflows and outflows. Then earnings. In your earnings, what are your revenues and other income that you are earning, that you will be focusing on. Next, measures the confidence interval for a decline in earnings during a specific period. Okay, and examines how earnings vary around expected earnings. Okay, Suman. So now we will have to focus on the concept rather than the place where I got this method. Okay, I shall get back to you after the class. So next up, we have earnings distribution. So here, the graphical representation of the probability distribution of various potential levels of returns. So now, focus on the earnings distribution. Okay, so now look like the investors. So when we view in the point of investors, it is easy for understanding earnings distribution. Okay, so now assume yourself as investors who has invested in various stocks. Okay, now your earnings has you have to calculate your earnings. So now what happens is, suppose you have invested in 3 different stocks. Okay, and your earnings that you are expecting from each of these stocks will be different. And the risk factors in the shares that you have invested will also be different. Got it? So now when you multiply this shares price along with the probability, then you will be getting your expected earnings. Okay. So here you can also involve a graphical representation of the probability distribution of various potential levels of return. So that is your earnings distribution. How do you distribute your earnings across various risk levels? The same thing with EPS. So now it's a graphical representation of the probability distribution of various potential amounts of EPS. Again, EPS is earnings per share. What amount of earnings you are earning per share. So now again in EPS, you will have invested in various stocks and you will have invested in stocks with various risk factors. Here you will have to find out your expected EPS. Okay. And you can also graphically represent whatever your EPS factors are. Got it? Then comes your benchmarking. Here compares the company's risk profile and potential risk impact with those of similar companies. Okay, so now what happens here? Benchmarking. We know that is comparison. So here we will be comparing the risk potential of the companies when compared to the same industries companies who are the top performers. We'll compare our performance with our top performers. That comes under benchmarking. So these are various qualitative tools and the quantitative tools that is used in risk analytics. Now let us come back to the question. So what are the other qualitative factors? Okay, so majorly we use risk heat map and portfolio view. Okay, so when we began our discussion today with enterprise risk management, I told you that we are using portfolio risk. We are creating the portfolios of risk. Okay, so these two are the mostly used qualitative methods. Risk heat map is the mostly used one, and portfolio, that is generally created in a firm. Any given firm in US who follows ERM, they will have to create their portfolio of risks. That also acts as their qualitative assessment. So why do they create this portfolio of risks? As I told you, risks are interdependent on each other. Okay, so there are some primary risks which will be causing two or more other risks. Okay, so when you solve this risk first, the primary one, you can automatically find the solution for the other ones which are caused by this primary risk. So that will be the major goal of creating portfolio of risks. Okay, so these are the two main qualitative risks that we qualitative tools that we focus on. Okay. So next up, we have risk prioritization. Okay. Okay, Suman, I think you are eagerly waiting for our next slides to come up. So wait until we discuss the entire risk concept. Then I think most of your questions will be answered. If not, I'll take your questions at the end. Got it? So let us not interrupt our discussion. We'll keep the questions at the end. Is that okay? Yeah. Okay, guys. So step 3 is about risk prioritization. Okay. So now risk prioritization. In the first step, we identified the risks. And in the second step, we focused on how do we assess the risks, both qualitative and the quantitative. Got it? So then in the step 3, we focus on risk prioritization. How do we prioritize the risks? So the basic prioritization will be as usual. Risks that are most significant for us, which is causing most losses, that will be addressed first. Then comes the risks that are least important, that are not frequent enough and that are not causing most losses for us. Okay. So that is about the risk prioritization. And for this evaluation, we have 4 main criteria. Okay. So we'll look at the first one. So that is known as expected loss. Okay. So what is this expected loss? Again, in a firm, we'll take a simple example of the sales. So now what happens with the sales? They will have various estimates as to sales revenue that can take place in a firm. So what will be their expected loss of sales? They will have an estimate. So due to various economic circumstances, they will have the risk factors against their sales. The risk that such expected sales might not occur. Okay. Now, whatever their sales value is, let us say, for example, 1 lakh sales, and the risk that they have in not achieving this 1 lakh will be 5%. And there is another risk revenue expectation, which is 1.5 lakhs. And the risk factor involved with this might be 5%, like this. All the risk sales revenue that they expect multiplied with all the risk factors, that gives them their expected loss of sales revenue. Okay. So according to the best of our knowledge, what is the expected loss that we can face in the sales revenue? That is the calculation of expected loss. So now, what about the unexpected loss? Suppose we have estimated that we will incur a loss of somewhere around 1 lakh. Okay. Suppose in a year, we have incurred a loss of 1.5 lakhs. Our expectation was only 1 lakh. Okay. Then our actual loss that we have incurred is 1.5 lakhs. So there is 0.5 lakhs of additional loss, which we did not expect at all. Okay, that becomes our unexpected loss. Okay, so when do we have this unexpected loss? In a very bad financial year, where our expected loss will be overcome by this unexpected loss. Then comes the concept of maximum probable loss and a maximum possible loss. Okay. So what is this maximum probable loss in the sense? In the given circumstances, according to the given economic circumstances, what is the maximum loss that we can face in a firm? That will be maximum probable loss. Okay. So now let me give you an example. Assume we are constructing a building. Okay. So we have already constructed 4 floors from the foundation till the third. 4 floors are already being constructed. So now assume that the latest floor that we are constructing, the 4th floor, we have found out that the raw materials that we have got, the cement and the steel, that was of a very poor quality, so that the walls of the building are not getting any stability. Got it? So now the maximum probable loss in this situation, where in the 4-floor building, the last floor got a faulty raw materials and it doesn't have strength. So now our maximum probable loss will be losing our latest built floor, that is our 4th floor. What is our maximum possible loss? Maximum possible loss will be losing the entire building. Suppose there is a natural disaster such as earthquake or thing that took place, we will have to lose our entire building. That is maximum possible loss. Okay. So probable losses, most probably. What is the greatest probability of loss that can take place? That is probable loss. Possible loss means the ultimate loss that can take place, the maximum possible loss that can take place, or we call it as a worst case scenario. That means we will lose all of our asset value. That is the worst case scenario. Got it? Okay, so this is what we focus on, risk prioritization. So then comes risk response strategies. So guys, can you guys tell me what are the risk response strategies we have? What are the 5 risk response strategies that we follow? Risk mitigation, yes. Okay, so risk avoidance, perfect. Acceptance, exploiting, perfect. Then one more. Risk transfer, yes, and risk retention as well. Good. Okay. Yes. So these are our 5 risk response strategies. So first step is avoiding or eliminating a risk. That means you don't want to take that risk at all and you want it to be completely eliminated. Okay. So when do we choose this avoidance or elimination strategy is we do something called as cost benefit analysis. Okay. So anybody for that choice, whenever they get a benefit more than the cost they are incurring, only then they will be interested in that activity. Okay. Similarly with risk response strategies as well. Organizations are ready to incur the cost for responding to the risks that they are facing. Okay. But what if the returns that they are getting for investing in such a risk response strategy, but the benefit that they are getting is very minimal? Suppose you are investing 1 lakh for a risk response strategy to avoid that risk, and the benefits you are receiving will be only somewhere around 10,000 or 15,000. Nobody will be interested in taking the risk of preparing the risk response strategies for it. So in that case, when your cost is more than the benefit you are able to get from the risk response strategy, your only choice will be to eliminate that risk. Okay. Then comes the risk reduction or risk mitigation. So here we will plan to reduce the risk. Suppose we definitely want to continue our business in a risky industry, but We don't want to face that much risk. So that now we will be reducing the risk impact that we are facing. Okay, so there will be various measures. It will be specific to industries. Okay, so they will be having many choices to reduce this risk. So I'll tell in a perspective of an investor. Okay, so investor can reduce their risks by diversifying their investments. That will be their risk reduction or mitigation strategy. Then comes risk transfer or share. We know a best example for this, insurance companies. Okay, so now transferring the risk or sharing the risk in a sense, here this transfer, it will be either partial or full. Okay, so partially in the sense, you'll be sharing your maximum risk with the insurance company. You'll be insuring for the maximum amount of risk for the company. But still some risk will be there. The prior example which we took for firecrackers firm. Okay, so they had bought an insurance for 1 million, but they found out a loss due to fire accidents of 1.5 million. So this is an example of partial transfer of risk. Okay, partial transfer of risk, you are transferring it only up to a level of 1 million. 0.5 million, you are still retaining. Or you can fully transfer as well. You can buy a insurance for 1.5 million. Then you will be completely transferring this risk to insurance company, provided we are paying regular insurance premium. Then comes risk retention. Okay, so what is this risk retention? So there was inherent risk. Assume there was an inherent risk and you have taken all the measures that is possible to reduce that risk. Okay, and even after taking all the possible strategies, there is some more risk that is still remaining. That is residual risk. Okay, and such risk it retains in a business. So leftover risk after insurance or hedges or controls will be remaining in a company. Okay, that is a residual risk and we will be retaining that risk. So then comes exploit or accept, risk exploitation or risk acceptance. So here what happens? We will be accepting the risk. So why does a company accept a risk? So they will be accepting a risk because we know that risk and returns are directly related to each other. The more risk you take, the more will be your returns. So businesses who want to succeed faster, earn faster, they will be exposing themselves for risks so that returns they get will also be higher. Okay, so now we'll take one company's example and analyze all of these strategies. So we'll just stick on to this firecrackers firm itself. Okay, now as the owner of firecrackers firm, if I want to eliminate the risk, so what I can do is I will be shifting my strategy towards another industry. I will not choose this firecrackers industry itself. I'll move on to another industry such as food and beverages industry or automobiles industry. So their fire accident chances are very less. So I will be avoiding this risk. Okay. Then comes risk reduction strategy. So again in the firecrackers firm, in order to reduce the fire accident risks, so we can install fire detection alarms and we can also take measures that it doesn't explode. Firecrackers don't explode in the company, in the firm. So that those are the reduction strategies which we can take. Risk transfer, again, we know that fire insurance can be purchased. Then risk retention. So after we have bought a fire insurance for 1 million, if we face a fire accident risk of 1.5 million, 0.5 million of risk is still retaining in the company. That is risk retention. Then comes risk acceptance. Now you know that firecrackers industry is booming like anything and you want to get the maximum out of this demand that is arising from the customers. At that point of time, you will accept the risk that is present in your industry and you will move on with your business. That is risk acceptance. Okay, guys. So now we shall take a small break for 15 minutes and we'll be continuing the class again from 5:45. Hello students, are you all back? Hello guys, I hope everyone is back. Okay. Yes. So next up, we have the concept of risk appetite and risk tolerance. Okay. So before understanding risk appetite and risk tolerance, we must know this concept of the risk capacity of the company. Okay. So what does this risk capacity mean in the sense? What is the maximum loss a company can face? Okay. So let us say, for example, a company is worth $5 million. Okay. So the risk capacity level for this company will be $5 million. That means losing everything it has. That is the risk capacity. Okay. So next, the strategic level, we have the risk appetite. So what is this risk appetite? So the risk capacity of the company in the example that we took is $5 million. In this risk capacity, what is the amount of risk the company is accepting to face? That is its risk appetite. It is ready to face. What amount of risk a company is ready to face? That is its risk appetite. Okay. And this varies from business to business. Some businesses, as I told you, they will have aggression in earning their profits, aggressive profits they want to earn. So they will be taking high risks. So in this example of $5 million risk capacity, which I told you, so they might have the capacity to assume somewhere around 20 to 30% of the value. Okay, so 20 to 30% of their risk control, they are choosing it as their risk appetite. They are ready to face that amount of risk. That is the risk appetite. Okay, and this will be set by the board of directors because they assume the position of the tone at the top. And those people have to take the strategic decisions. So risk appetite is fixed by board of directors. Okay. So next up, we have risk tolerance. So what is this risk tolerance? So we took an example of $5 million of risk capacity. In that, I have chosen my risk appetite to be somewhere around 20 to 30%. Okay. So I'm ready to take that amount of risk. Okay. What comes in risk tolerance level is normally without impacting my core businesses, without impacting my very own survival or existence in the industry. What is the risk that I can take normally? That is risk tolerance. Okay. So in this, let us assume that our risk appetite was somewhere around 2 lakh rupees. Okay. In this 2 lakh rupees, our risk tolerance will be, let us say, somewhere around $50,000. So what does that mean? If I'm incurring a loss of up to $50,000, that doesn't have any impact on my business. Okay, my business normally what it was following. Similarly, my business continues without being impacted by this loss. Okay, that is risk tolerance level. Even if risk occurs, my businesses will not be impacted. I will be casually running my business. But risk appetite is maximum level of loss I am ready to take. That is risk appetite. Okay. And one more important thing, risk tolerance is in the operational level or in the tactical level, whatever risk we are facing without causing maximum impact on our normal businesses. Okay. So next up, we have enterprise risk management. So this is the COSO framework and strategic planning. So now let us look into ERM. Okay. So now, as I told you earlier, ERM is a very statistical approach into our risk management. Got it? So now this framework called COSO. So what is this COSO? Committee of Sponsoring Organizations of the Tradeway Commission. Okay. And in the year 2004, they bring up the new definition. They bring up the concept of ERM. So what was the purpose behind this ERM in the sense? In the early 1980s, okay, there were many business scandals that took place. So scandals in the sense there were so many bribes that were occurring in a company, and owners of the business wantedly they used to disguise their accounts in the sense they were not disposing they were not disclosing the actual financial performance of their organization. They were hiding many things. So now there was a risk of transparency in their financial reporting and the risk of transparency in their business practices. Okay. Now to avoid this risk, all the institutions such as AICPA, IMA, IIA, FEI, and AAA. So all these are major institutions which carry on some of the strategic works in a company. Suppose in the C-suite officers, we could find CMAs, CPAs, CIAs, all of them are C-suite officers. These people, they overview the financials of the company, they overview the actual performance, whatever is taking place in a firm. So all of these institutions came together for introducing COSO ERM. Okay. So now what is this COSO ERM? The culture, capabilities, and practices integrated with strategy setting applied during strategy execution with the purpose of managing risk in creating, preserving, and realizing value. So this is how they defined ERM. Okay. So now two most important things that we need to focus here is they focus majorly on culture and capabilities, and also they are integrating it along with the strategy setting. Got it? And we also focus on creating, preserving, and realizing the value. Now let us understand what was the need of this. So in this strategy setting, so we know that from the inception of the business till the time it comes to an end, everywhere risk is involved. Okay, so strategic planning is the very first step that we take in the business. So now what happens in the strategic planning itself? If we bring into the practices of risk management, then it will be easy for us, and in an easy manner and in an earlier manner, we can bring in risk management practices in the firm. So that is why they wanted to integrate with strategy setting. Okay, and in creating our value, in achieving our objectives, this ERM practices were very much important. So now, COSO ERM, they gave us the framework in the sense, what are the important aspects of the business in which risk management should be present. Okay, so they disclose the entire framework in terms of 5 components and 20 principles. So the 5 components are, and this is an important concept, you all need to memorize this. This has to be known exactly how it is. Okay, so first component was governance and culture. Next up, we have strategy and objective setting. Then we have performance, followed by review and revision. At the last, we have information, communication, and report. So each of them have principles. So here in the first component, governance and culture, we majorly focus on the board responsibilities. Okay, so board are the tone at the top. Okay, and they always have the oversight responsibility. Okay, so remember, in any activity that takes place in the organization, all the employees have to be involved. Everybody, starting from employees till top level management, everybody needs to take place in that activity. It's everyone's responsibility. Okay, and one person will have ultimate responsibility of making sure that things are going well in the business. Okay, that is the responsibility of CEO, taking ultimate responsibility of all the activities. But what about this board of directors? They will be overseeing whether everything is running well in a business or not. Oversight responsibility will be with the board. So now board oversees strategy and governance to support the management. Okay, then comes establishing operating structures. According to our objectives, we will be defining the levels of management and various roles and responsibilities of various job roles. We will be structurizing them. Okay, so that is creating operating structures. Then comes defining desired culture. So culture comes as a corporate governance. Okay. Corporate governance is very pillar upon which entire organization stands. So this culture and behavior of everybody in a firm is important in achieving the objectives. Then comes demonstrates commitment to core values. Okay. So core, there has to be a commitment to the core value or ultimate objective that we need to earn in a business. Okay. So everybody needs to be committed for that ultimate goal and objective, ultimate value creation. So then attracts, develops, and retains capable individuals. Okay. So important talents or very valuable talents of individuals is also called as a asset to the company. Okay. They will have to retain it. So these are the 5 principles under the component governance and culture. Then comes component 2, that is strategy and objective setting. Okay. So here it analyzes the business context. So the risk levels that businesses face depends on the type of businesses they are. For some businesses, risk profile will be high. That means they will have to face high risks. For some businesses, it will be relatively low. So to design their risk profile, they should understand what is the kind of business, what is the business context. Then comes defining the risk appetite. Okay, so what is this risk appetite? We came to know what is the level of risk we want to take in our business in order to create, preserve, and realize the value. Then comes evaluating alternative strategies. Okay, so now let us say our risk appetite is to face any loss somewhere around, let us say $200,000. So our business strategies, when we see, according to the strategies also there are risks. If the risk that I am willing to, if the risk I am supposed to take for a specific strategy, if it crosses more than our risk appetite, then we will have to choose some alternative strategies. Okay, so businesses usually don't accept any risk above their risk appetite. So at that point of time, we will have to search for alternative strategies which give us risk, which is within the extent of our risk appetite. Okay, this is one of the purposes why we evaluate alternative strategies. And initially also, in order to select the best strategy, we will evaluate alternative strategies. So here, evaluating alternative strategies and potential impact on risk profile. Then comes formulation of business objectives. Based on our risk profile, we will be choosing our objectives. So then the third component, performance. Okay, so performance we have already come to know. In performance component, we mainly address the risk factor. Identifying the risk, assessing the severity of risk, prioritizing risks, implementing risk responses, and developing portfolio view of risk. In this portfolio view, again, we will have what type of risks are present, what is their frequency, and what is their severity. So these things will be present in the portfolio view. Then comes component 4, which is review and revision. So here what happens? It assesses substantial change. So what is this substantial change? So let me give you an example. So our business environment is very dynamic in nature. That means every now and then it will keep on changing. And when we strategize our risk responses, we will choose the risk responses which is particular for a specific business environment. So for a specific business environment scenario that is present as of that time, we will create our risk response suitable for that. And this business environment continuously it changes. Okay. And similarly, we will have to assess what is the change that took place in the business environment. How do I have to change my risk response in order to avoid or mitigate the risk? So constantly we have to assess substantial change that is taking place. Changes that may substantially affect our strategy on and objectives. So these changes, majority of these changes will be from reviews risk and performance. So reviews entity performance and considers risk. Okay. So here again, we will be reviewing whatever performance we have done as of now and any other risk other than that for which we have responded already, any other new risks have occurred in a business, and we will have to again, the same cycle repeats, find out the risk response for that. Then pursues improvement in ERM. ERM is enterprise risk management. Continuous improvisation should be there. Because the main reason for this continuous improvement is business environment is dynamic. Every now and then changes. It changes. Okay. We can't use the same old strategies for new risks that are coming up in the business. So continuously we have to improve ERM as well. So next component, the fifth component is information, communication and reporting. So here leverages information systems. Here we use the information and tech systems. So we discussed earlier about the intranet communication systems that we set up in a business. So that risk, if there is any risk factor in a business, it will be quickly and easily communicated. Then comes communicating risk information. We use communication channels to support ERM. So usually top-down approach. So top level managers, and it will be two-way round as well. Two-way communication will be there. So some of the major risk reduction practices that should be followed by everyone, it will be communicated from top management. And if there are any new risks that has been found out in the lower level, again, that will be communicated to the top level management. Enhanced communication should be there. Then comes reporting on risk, culture, and performance at multiple levels across the entity. Okay, so again, we will always have to keep a check on risk, culture, and performance. And continuously, we need to check that they are in they are towards achieving our objectives. So risk, culture, and performance all together, it should support us for achieving objectives. And every now and then we have to report on them. Okay, so these are the 5 components of COSO ERM. Okay, so next up, what are the benefits and limitations of ERM? Okay, so now enterprise risk management, that here we also conduct this analysis. So SWOT analysis. Okay, so we will come to know more opportunities. So what are the risks that we have and what are the opportunities that these risks are creating for us? Then covers all risks across entire business, not just one area. Then fewer bad surprises and more opportunities, because as we are reducing the risk impact, bad surprises will be reduced as well. Then better resource allocation. So it helps us to enhance our efficiency by allocating our resources in a best possible manner. Then stronger resilience, better at handling changes. So we came across this COSO ERM principles. Okay, there we came to know that continuously we should view on substantial changes that are taking place. So we will be better at handling changes. Then smarter strategy. So based on various levels of risks that are present, we will strategize better. Then trust building. Okay, this is important. So when we take an example of a company, there will be many stakeholders involved. Okay, so these many stakeholders, we have to build the trust among all of them. Okay, so whenever these stakeholders are involved, if company is facing lot of risks, their trust will be reduced. So nobody will trust on a risky company, which is not sure whether it will exist, whether the business will exist in the coming year or not. If the risk of the business is to such an extent, then trust usually will not be there on the part of the stakeholders. To build sufficient trust among the stakeholders, what do we need to do? We should have very good enterprise risk management systems. The well you manage the risk, the more the trust we can build on stakeholders, because nobody will be interested to invest in a failing company that has a lot of risks. Then adapting to change. So change is always constant. So we will have to adapt to the changes, and ERM helps us to do so. And there is one limitation. Okay, so even in spite of taking all these measures, nobody can give 100% assurance that risk will be completely eliminated. Nobody can give 100% assurance. Okay. So we will only give reasonable assurance, stating that to some extent we will be able to reduce the risk impact. Okay. So the biggest limitation is nobody can guarantee success or complete risk elimination from the business, from ER. So next up, as I told you earlier, so what happens is strategic planning is the very first step that we take in the business, and risk is present from the inception of the business till its end. So it will be really a good option to integrate our enterprise risk management along with strategic planning, because strategic planning is involving throughout the company's entire operations is involved in the strategic planning. So if we build in risk management within the strategic planning, then it will be implemented easily, quickly, and in a timely manner throughout the company. We can implement it very well. Okay. So next up, we have the concept of capital adequacy. So what is this capital adequacy? This concept is with respect to banks. Okay. So banks, these are the most important financial institutions in any given country. Okay. Why it is such an important financial institution? Because if you notice carefully, for any given country, in order to develop a country, its citizens have to develop. Okay. And these citizens, whatever they earn after spending, their savings will be, majority part of their savings will be kept in banks. Okay. So most of the reputed investors, what they see is how they invest in a country is they see how banks are improved in that country. Because as in how banks are improving in a country, it shows that country is also improving in a same way. To that extent, banks are important financial institutions for any given country. So now when people are they are keeping all their savings, most of their savings in bank, and they are mostly dependent on banks for loans and for their deposits, and for most of their security purposes. They will be ensuring that their funds are kept in the bank. Okay. So now banks are such a important financial institutions, and we have to regulate them very well. Okay. So these banks will have a regulator. Okay. So in India, the regulator of banks will be RBI. Similarly, in US, there will be a regulator for the banks. So now what happens? In this capital adequacy ratio, these regulators want the bank, okay, to have their assets, to have their fund strength or the assets to be greater than the liabilities. Okay. So whether a bank has enough capital versus its risks and liabilities to absorb potential losses and remain solvent. To remain solvent in the sense their ability to repay the long-term debts and still have sufficient funds. Okay. That is capital adequacy. So now, in order to ensure this capital adequacy, there are some steps that banks will have to follow. So first step is backup resources. In terms of unexpected disruptions, what is the backup plan for the banks? Where do they get their cash and liquidity from? It has to be very well planned. Okay. Then more resources will be equal to more risk capacity. The greater the resources that banks have, their risk capacity will increase. Okay. And they will be able to handle bigger risks for the economy. Then banks are critical. As I told you, they are the very much important financial institutions for the growth of the company, for the growth of the country. Okay. Then expected versus unexpected losses. Banks plan for expected defaults. That is, capital absorbs the unexpected or larger losses. That means the capital that banks have. So how do banks get capital? It will be usually through issue of government securities. Okay, so they will have people who invest in their stocks. So their capital should be greater than, if we have any unexpected losses, capital should be such large that we will be able to cover those unexpected losses as well. Then Basel Accords. So these are international banking rules. Okay. So here international banking rules, it ensures banks hold enough capital globally. So there are banks that are globally present. So their capital has to be present in a sufficient manner. They should have sufficient capital. Then too big to fail. As I told you, banks should not fail in a country. If it fails, then it could cause severe financial crisis for the country. Okay, now we have something called as CAR, capital adequacy ratio. So what is this capital adequacy ratio? Tier 1 capital plus Tier 2 capital divided by risk weighted assets. So what is this Tier 1 capital, Tier 2 capital in the sense? Okay, Tier 1 capital in the sense, so these are the core capital for the bank. So where do they get these core capital? It is from common stocks and through the investments from general public. There are some people who invest in government securities. So they will be getting their capital from that. Tier 2 capital in the sense, like how we have in our businesses. So whenever assets improve in their value, so we will notice a gain on that, gain on the value of assets, isn't it? Similarly, banks also, they have assets. So what are their assets? Deposits of people, and there will be many people who buy these lockers to store their jewels and all. So these jewels and all which they have kept in the bank, all of them together put up as bank's assets. Okay, so if there is any increment in the assets value, that comes as a Tier 2 capital. They mostly don't depend on Tier 2 capital. Most revenue, most income will be from Tier 1 capital itself. So divided by risk-weighted assets. Risk-weighted assets in the sense, so banks usually give loans to people. Okay, so I'll take two examples. The banks will be giving some personal loans and credit cards. Okay, so credit cards, they have highest risk. Many people can default on their credit cards easily, and personal loans also, they have risk, but not as much as credit cards. Okay, so these risk weighted assets, they will have to find out the risk percentage. It will be anywhere up to 200%. Okay, up to 200% they can assign any weights. So risk weighted assets will be in the denominator. So now this thing, Tier 1 capital plus Tier 2 capital divided by risk weighted assets should give us at least 8% CAR. That's the minimal ratio that we expect. Ideal ratio that we expect, 8%. Okay. Yes. So you just have to remember this formula in this concept. And Tier 1 capital, we will be having common stock plus retained earnings plus non-redeemable or non-cumulative preferred stock, the equity section. Okay. Then in Tier 2 capital, reserves, provisions, and any gains that we have on our assets that will be realized in Tier 2 capital. Core capital will be Tier 1 itself. Okay. So these are the main concepts that we need to know in section D, risk management. All of you are clear with all the concepts that we discussed till now? If you have any doubts, we can discuss it now. Okay, guys, all 6 of you, if you guys are clear with the concepts, you can type in yes. If you have any doubts, you can ask me. Okay, Rafia. What about remaining students? Okay, Pooja. Yes, Sandhya. Okay, so earlier we had a doubt asked by Sumant in this session. So is he there? Okay. So let me answer this question. So this question was about the qualitative tools that we have and the quantitative tools. Okay. So there are n number of qualitative and quantitative tools that are present for any given business for evaluation. Okay. So mostly we will be focusing on risk map or risk heat map. And the next thing or this thing, that is creation of portfolio of risks. Okay. So this is the first step that they take. Okay. So if we consider any other important qualitative tools, you can consider this creation of risk portfolio as well. Okay. So now this concept of risk ranking, which he asked about. Okay. So what is this risk ranking in the sense? Risk prioritization. So rather than viewing this as a qualitative aspect. So yes, of course, it can be one of the qualitative factors because we spoke about creating a risk map or a risk heat map. Okay. So guys, now you guys try yourself analyzing the risk heat map. Okay. So when you see the visuals of this graphical representation, you automatically will come to know which risks you are going to rank first. Okay, and which are going to be ranked next. Okay, so now the risks that you have, which have the highest frequency and highest severity, those will be addressed first. Okay, then comes your risks which have highest severity but low probability. Those will be addressed next. Okay, and in the risk map, risk heat map itself, you will come to know what are the risk response strategies you will have to take. Okay, so if the severity of risk and its frequency, if it is very high, now you guys guess and tell me if the risk frequency and risk severity, both of them are very high. In the 5 risk responses, which one you will choose? Don't worry whether the answer is right or wrong. You just answer. If the risk severity and frequency is very high, which risk response you think is most apt? Okay, good, Sandhya. What about remaining students? All of you answer. Perfect. So it will be avoidance of risk. Okay. So by looking at the risk heat map, you will come to know what are the strategies you can take. So which risk you have to prioritize or rank first. Okay. So these are all qualitative measures. And here we are focusing only on most important qualitative measures, which is why I was not able to cover everything. So in exams perspective, be clear. So you just need to focus on risk heat map and its analysis. Okay. And then at the initial stages of ERM itself, we will be creating a portfolio of risk. That is all it is. Okay, guys. So I hope everybody is clear with all the topics which we discussed in today's booster session. So let me give you some tips as well. So this is a theory section. Okay. So whenever you look and read at the sentence or the question or the scenario they are asking, so it will be best if you read it twice. As it is theory, there are chances that the question may be demanding something and you might understand the requirement of the question as something else. That is common, that's natural. Okay. So if you read it twice, you will get a clarity as to exactly what is the requirement of the question. This will resolve 50% of the chances of choosing a wrong option because of not understanding the question properly. Okay. Any given theory question, if you don't get a clarity, read it twice. Okay. And what I would suggest is do not look at the MCQ options for theory questions, especially because soon after reading the question, if you look at the options that they have given, you will find for most of the questions, you will feel that all the options are correct. Okay. For that, what you need to do is read the question, get the clarity. You find out the answer first for yourself. Find out what could be the possible answer for this question. You find it out first. Then go on reading the MCQs. Whatever this thing, options they have given. Okay. This will reduce the most probability, it will reduce that you are choosing a wrong option. So always look for keywords and understand the requirement of the question exactly. Okay, guys, are we good to end the session? If you have any doubts, you can ask me. Thank you, Rafia. Perfect, guys. So all the best for your exams. Thank you all. Thank you, Shreya. Yes. Tomorrow's session also will be same time from 4 to 7. Okay, guys. Thank you all. Have a nice day.